All right. Welcome back, everyone. Today we're taking a deep dive into the world of bonds.
Bonds.
We're going to be looking specifically at a chapter from Keith Redhead's Personal Finance and Investments.
Okay.
I know you guys want to master this topic like quickly and thoroughly, so we're going to break it all down for you today.
Sounds good.
So, bonds. You probably already know they're all about lending money, right?
Yeah.
But did you know that people actually invest in things called junk bonds?
Yeah.
It's like the high-risk, high-reward corner of the market.
Exactly.
And get this, governments can actually make their bonds disappear before they're even due.
That's interesting. A lot of people think of bonds as this super safe investment,
Yeah.
but there's actually a whole spectrum of risk involved. You've got your rock-solid bonds, and then you have some that are, well, a little more adventurous.
Okay, so let's start with the basics.
Sure.
Bonds 101, we're basically talking about IOUs, right?
Yeah, essentially.
Governments and companies, they issue these bonds to borrow money.
Right.
And in return, they promise to pay back the original amount plus a little extra, like a thank you for lending them the money. That extra bit is called the coupon.
Exactly.
So it's like lending money to a friend, but with a legally binding agreement.
Yeah, like a guaranteed return. But it's important to remember not all bonds are the same.
Right.
Government bonds, like UK gilts, those are generally considered safer than corporate bonds.
Okay.
But even within those categories, you've got different levels of risk.
Gotcha.
Think of it like a ladder. Some bonds are sitting comfortably on the lower rungs,
Right.
and others are like way up there, kind of precariously perched.
Oh, okay. So let's climb up that ladder a bit and talk about corporate bonds.
Okay.
I'm already intrigued by these terms like debentures and loan stock.
All right. Well, imagine you're lending money to a company.
Yeah.
Wouldn't you feel better if that loan was backed by some of their assets? Like something valuable they own?
Yeah, of course.
That's basically what a debenture is. It's a corporate bond, but it's secured against some of the company's assets.
I see.
So if things go wrong, debenture holders have a higher chance of getting their money back.
That makes sense.
Loan stock, on the other hand, that's unsecured.
Well, it's riskier.
A bit riskier, yeah.
So I'm guessing those unsecured bonds come with a higher interest rate, right?
Got it.
To make up for that extra risk.
Exactly. Investors need a little something extra to take on that risk. And then there's another layer of risk. It's called seniority.
Seniority.
Yeah, think of it like a pecking order.
Okay.
Like if the company goes bankrupt, who gets paid back first?
Right.
Senior debt, that gets paid back first. Then you have subordinated debt,
Okay.
which is riskier and therefore usually has a higher interest rate.
So it's all about balancing risk and reward.
Exactly.
Now, tell me about these junk bonds. The name itself sounds a bit, well, risky.
Yeah. I mean, it does have a certain ring to it, doesn't it? It refers to bonds that are issued by companies with, let's say, less than stellar credit ratings.
I see.
Think of it like venture capital, but for bonds.
High risk, potentially high reward.
Exactly.
So navigating this bond market sounds like it requires a pretty good compass.
Yeah, for sure.
So that's where bond rating agencies come in.
That's right. They come in and help investors understand the risks involved.
Okay.
You've got independent agencies like Moody's and Standard & Poor's.
I've heard of those.
They assess how creditworthy bond issuers are. They're basically giving them a credit score.
So if I'm looking at a bond and it has like a AAA rating,
Then you can feel more confident.
yeah,
But if it has a lower rating, maybe proceed with a bit more caution.
right. So these ratings have real-world consequences. Like a lower rating could mean a company has to offer a higher interest rate to get people to buy the bond.
Absolutely.
And remember the 2007 subprime mortgage crisis.
Oh, yeah.
Bond rating agencies were kind of in hot water then.
They were. They gave high ratings to some risky investments.
And it shows that even expert assessments can be wrong sometimes.
Yeah,
So doing your homework is important.
very important.
Now, hearing there's a whole variety of bond types out there.
Oh, yeah.
What are some of the flavors we should know about?
Well, there's something called floating rate notes, or FRNs. The interest rate adjusts periodically, like it follows the market.
Oh, interesting.
It's like having a built-in interest rate adjuster.
Okay.
And then you have zero coupon bonds. They don't pay interest regularly, but you buy them at a discount and they mature at their face value.
So it's like buying something on sale knowing it will be worth more later.
Exactly. And then you have step-up bonds.
Step-up bonds, like you get a raise on your investment over time.
That's a great way to think about it. The interest rate on a step-up bond actually increases periodically.
Okay.
They can be really appealing to investors who are looking for growing returns. It's actually a win-win because issuers can attract investors with a lower initial interest rate.
I'm starting to see that bonds aren't one size fits all.
Definitely not.
There's a whole world of options out there. Now let's talk about those UK gilts, the government bonds. They're seen as really safe, right?
They are. UK gilts are often considered a staple for a stable investment portfolio.
Okay.
They're issued by the UK government, and since they're backed by the government's ability to tax, they're considered very low risk.
So they're like the bedrock of the UK bond market.
You could say that, and even within the world of gilts, there's a lot of variety.
Oh, okay.
You have conventional gilts with fixed interest payments and a set maturity date.
Right.
Then there are double-dated gilts where the government can choose to repay early, and then you have undated gilts.
Undated date.
Yeah, no maturity date at all.
So the government could just keep paying interest forever?
Potentially.
Yeah.
They're like this perpetual income stream. But of course, there's a catch.
Go on.
Their value can fluctuate depending on how interest rates in the market move.
I see.
And let's not forget about index-linked gilts.
Right.
These are designed to protect investors from inflation.
Oh, that's interesting.
Their interest payments and principal value are actually adjusted based on inflation.
So your returns keep up with the rising cost of living.
Exactly. It's a way to maintain the purchasing power of your investment.
Now, that sounds like a superpower for anyone worried about their money losing value.
It can be.
So before we dive deeper into the different types of gilts, can we go back to bond prices fluctuating?
Sure.
That inverse relationship between bond prices and interest rates, I'm still trying to wrap my head around it.
Yeah, it can be confusing.
It makes sense that if interest rates go up, existing bonds with lower rates are less attractive, but how does that play out in the market?
Okay, let's use an example. Imagine you buy a bond today for $100.
Right.
And it promises to pay you 5% interest every year for 10 years.
Okay.
Now, let's say interest rates suddenly jump to 6%. New bonds are going to be issued at this higher rate, right?
So those would be more appealing.
Exactly, because they offer a better return. So if you wanted to sell your 5% bond now, you would probably have to lower the price.
To compete with the 6% bonds.
That's how the inverse relationship works. When interest rates rise, bond prices fall.
So it's not that the bond itself changes,
Right.
but it's the value relative to other investments.
Exactly. It's all relative.
And that brings us to that redemption yields we talked about before.
Yes.
It considers not just the coupon payments, but also the potential capital gain or loss
Right.
if you sell the bond before maturity.
Exactly.
So it's a more complete way to look at a bond's return.
Absolutely. It takes everything into account.
So we've talked about governments and companies issuing these bonds,
Yeah.
but who's actually buying them?
Oh, it's a diverse group. You have institutional investors like big pension funds and insurance companies.
Okay.
They buy a lot of bonds. It's part of their long-term investment strategy.
So it's not just individuals buying these.
No, not at all. Institutional investors actually play a major role in shaping the bond market.
Interesting.
And then you have individual investors, of course, who might buy bonds directly or through mutual funds or ETFs.
Right.
It's all about finding investments that match your risk tolerance and goals.
Now, we've been talking about how government bonds are generally considered safer than corporate bonds. But how do investors figure out where a particular bond sits on that risk spectrum?
Well, that's where those bond rating agencies we talked about earlier come in.
Right.
They assess the creditworthiness of the bond issuers and give them a credit score.
So it's like a quick way to assess the riskiness.
Exactly. It's a crucial piece of information, but as with any investment, do your own research.
So don't just rely on those ratings.
Exactly.
Now, why do bonds matter so much in the bigger picture? What's their role in the overall economy?
Well, bonds are more than just investments. Governments use them to fund public services, to build infrastructure and respond to crises.
Wow.
They're kind of like the fuel that keeps the government running.
So it's not just about individuals making money, it's about how society functions.
Exactly. It's all interconnected. And for companies, bonds allow them to raise capital, to expand, to invest in research and development, to create jobs.
So bonds are a really important part of everything.
They are.
Are there strategic ways to approach bond investing?
Oh, absolutely. There are all kinds of strategies investors use. One common strategy is called laddering.
Laddering.
Yeah, you basically invest in bonds with a range of maturity dates.
So instead of putting all your eggs in one basket, you spread them out.
Exactly. And that can help to reduce your risk. Imagine you have a 5-year investment horizon.
Okay.
You could invest in bonds that mature in 1 year, 2 years, 3 years, 4 years, and 5 years.
And as each bond matures, you reinvest.
You reinvest the proceeds into a new bond with a longer maturity, so your ladder stays intact.
That's a clever way to do it.
It's a particularly useful strategy when interest rates are rising because you can reinvest at those higher rates as your shorter-term bonds mature.
That makes sense.
Mm-hmm.
Okay, so we've covered a lot, from the basics of bonds to the different types of gilts and even some strategies that investors use. But before we wrap up, we have to address the big elephant in the room,
Okay.
inflation.
Right.
We've talked about how inflation can really eat away at the value of your investments. So how do bonds fare in an inflationary environment?
It's a great question. And as with most things in finance, the answer isn't simple. Bonds can be impacted by inflation in a couple of ways. First, as prices rise, the purchasing power of those fixed interest payments you get from bonds goes down.
So that 5% coupon might not seem so great if inflation is running at 6%.
That's a good analogy. The other way inflation can impact bonds is through its effect on interest rates. Central banks often raise interest rates to combat inflation.
And we already know that when interest rates rise, bond prices fall. It's that seesaw we talked about.
That's right. So if you're holding a bond with a fixed interest rate and inflation causes those interest rates to go up, the market value of your bond could drop.
And that's not ideal if you need to sell the bond before it matures.
Exactly, which is why it's so important to consider inflation when making decisions about bond investments, especially if you're investing for the long term.
So are there any types of bonds that can help with this inflation risk?
There are actually.
Like index-linked gilts, right?
Yeah, index-linked gilts are a great example.
They seem like a powerful tool.
They can be. As we discussed before, the interest payments and principal value of these gilts are adjusted to keep pace with inflation.
So your returns increase along with inflation.
Exactly. It helps protect the purchasing power of your investment.
It's like a shield against inflation.
You could say that.
What about those floating rate notes, FRNs? Did
Those-
they help with inflation?
To some extent, yeah. The interest rate on an FRN is usually tied to a benchmark rate, something like LIBOR or the Bank of England base rate. So if those rates rise due to inflation, your coupon payments on the FRN will also increase.
So it's kind of like a flexible interest rate that adapts.
That's one way to put it. But keep in mind, FRNs don't provide the same level of protection as index-linked bonds because their interest rates may not always keep up with inflation.
So as always, it's about understanding those trade-offs,
Right.
choosing the bond that works best for your goals.
Absolutely.
Okay, let's shift gears a little and talk about credit risk.
Okay.
We talked about how government bonds are usually safer than corporate bonds.
Right.
But even within those categories, there's that range of risk.
Absolutely. Credit risk is a big thing to consider. It's basically the risk that the bond issuer, whether it's a government or a company, might not be able to make their payments.
So they might default.
Exactly.
And I imagine bonds with higher credit risk usually offer higher interest rates
They do.
to make up for that extra risk.
Right. It's that risk-reward balance.
It's like climbing higher up that risk ladder. Bigger rewards, but also bigger potential for things to go wrong.
That's a great analogy. And that's where those bond rating agencies we talked about earlier come into play. They really help in assessing the creditworthiness of those issuers.
They give those bonds a grade, basically.
Exactly. So investors can see the likelihood of default. A high rating means lower risk. Lower rating signals higher risk.
Okay. So those ratings are a good place to start, but it's important to do your own homework, too.
Oh, absolutely. Don't rely solely on those assessments.
You gotta look under the hood.
Right.
Figure out what could affect the issuer's ability to meet their obligations.
Exactly.
So bond investing, it's a bit like detective work.
It kind of is. It's engaging, though. You're actively evaluating, assessing risks, making decisions.
This deep dive into bonds has been quite the adventure so far.
It has.
But before we wrap up this part of our journey, I want to touch on something that affects all investors.
Okay.
Taxes.
Yes. The unavoidable topic.
We've talked about the returns and risks of bonds, but how are those returns taxed?
Well, the tax treatment of bond income can vary depending on the type of bond and where you live.
So let's talk about the UK specifically. How are bond interest payments taxed here?
Right. So in the UK, interest income from most bonds is considered taxable income.
So you have to report it on your tax return.
That's right. But there are some exceptions, and this is where it gets a little more interesting. For example, interest income from UK gilts is actually tax-free.
Wait, really? So if you invest in UK government bonds, you don't have to pay taxes on the interest you earn?
That's correct. It's one of the perks of investing in gilts. It can make them a particularly attractive option for certain investors, especially those who are in higher tax brackets.
So it's not just about the yield, it's about the after-tax return as well.
You got it. And there are also some tax-efficient wrappers like ISAs, where you can hold bonds and potentially shelter some of your interest income from taxation.
That's something to keep in mind. Now, what about capital gains tax?
Right, so if you sell a bond for more than you paid for it, you may have to pay capital gains tax on that profit.
I see.
However, everyone has an annual capital gains tax allowance, so you can make a certain amount of profit from selling investments each year without having to pay any tax.
That's a good thing to remember. So it's all about planning strategically and understanding the tax implications of your investments.
Exactly. It's always a good idea to seek professional advice if you're unsure about the tax implications of your investments.
Wise words. Well, folks, this has been quite the whirlwind tour of bond basics. We've covered a lot of ground, but it seems like we've only just scratched the surface of this vast and fascinating world.
We have, and there's so much more to explore. But I think this is a good foundation for now. We've laid out the key concepts, the different types of bonds, the risks to consider, and even how taxes can come into play.
So what's next on our bond adventure?
Well, we've talked about the different flavors of bonds and how to assess the risks involved. But now I think it's time to dive deeper into how to actually evaluate and select specific bonds.
Sounds like a plan. Get ready, everyone, because we're about to unlock the secrets of bond analysis.
We'll learn how to decipher those financial statements, analyze credit ratings, and make those informed investment decisions.
I'm excited. Let's do it. Welcome back to our deep dive into the world of bonds.
Back for more bond knowledge.
So last time we talked about the different flavors of bonds, the risks, and even taxes.
Yeah, we covered a lot of ground.
But now let's get down to the nitty-gritty. How do we actually evaluate these bonds?
Okay, so when you're looking at a bond, it's kind of like checking out a car before you buy it.
Yeah, you kick the tires, look under the hood.
Exactly. You want to make sure it's a good investment. And with bonds, there are some key things to consider.
Like what?
Well, first, you got to look at the issuer's creditworthiness.
Right. How likely are they to actually pay us back?
Exactly. Remember those bond rating agencies we talked about?
Moody's, Standard & Poor's.
Those guys, yeah. They give bonds these ratings based on the issuer's financial health.
So those ratings are a good place to start.
Definitely. A higher rating generally means the bond is less risky.
Okay, so higher rating, lower risk. But we can't just rely on those ratings alone, right?
Nope. It's important to dig a little deeper.
So what else should we be looking at?
The bond's yield. That's a big one.
The yield, that's the return we can expect to get on the bond, right?
Exactly. It's usually expressed as a percentage. Now, there are actually a few different types of yield to consider.
Oh, okay, wait, what?
Well, there's the coupon yield, which is simply the annual interest payment divided by the bond's face value.
Straightforward. No.
Then you have the current yield, which takes into account the current market price of the bond.
So that reflects any changes in the bond's price since it was issued.
Exactly. And finally, you have the yield to maturity, which is probably the most important one.
Yield to maturity, that sounds like a mouthful.
It is, but it basically tells you the total return you can expect if you hold the bond until it matures, taking into account the interest payments and any capital gains or losses.
So it's the most comprehensive way to assess a bond's potential return.
Precisely. Now, the yield on a bond is influenced by a bunch of factors.
Oh, yes.
Well, interest rates, inflation, the issuer's creditworthiness, and even the overall economic outlook.
So it's not just a fixed number, it can fluctuate.
Oh, yeah. Bond yields are constantly moving up and down as market conditions change.
Makes sense. So if I'm looking for a bond with a higher yield, I might have to take on more risk.
That's generally how it works, yeah. Higher risk, potentially higher rewards.
Okay, so we've got creditworthiness, yield. What else should we be factoring in when evaluating a bond?
Well, the maturity date is another important consideration.
That's when the bond issuer has to pay back the principal, right?
That's right. And bonds come with a wide range of maturities, from a few months to several decades.
So how do you choose the right maturity for your investment?
Well, it depends on your investment goals and time horizon.
Okay, so if you're investing for the long term, like for retirement,
You might want to consider bonds with longer maturities.
but if you need the money sooner,
Then shorter-term bonds might be a better fit.
so it's about aligning the bond's maturity with your own investment timeline.
Exactly. Now, here's a little insider tip.
Oh, I love insider tips.
When interest rates are expected to rise, it's usually a good idea to go for shorter maturities.
Why is that?
Because when rates rise, the value of existing bonds tends to fall, And that impact is greater for bonds with longer maturities.
So if you have a shorter-term bond, you can reinvest your money at a higher rate when the bond matures.
You got it. You're catching on quickly.
I'm trying to. Now, I'm also curious about this concept of duration. I've heard that it's an important measure of a bond's interest rate risk.
Oh, yes. Duration. It's a bit of a technical concept, but it's basically a measure of how sensitive a bond's price is to changes in interest rates.
Okay, so a bond with a longer duration,
Will be more sensitive to interest rate changes.
meaning its price will fluctuate more if rates go up or down.
You got it. Now, duration is measured in years, and it's not always the same as the bond's maturity.
Wait, so a bond with a 10-year maturity might not have a duration of 10 years?
Not necessarily. The duration is also affected by factors like the bond's coupon rate and the current level of interest rates.
So it's not a simple one-to-one relationship.
Nope, it's a bit more complex than that. But the key takeaway here is that duration is a useful tool for understanding how a bond's price might react to changes in interest rates.
So it's like a measure of a bond's volatility.
Exactly. Now, if you're concerned about interest rate risk, you might want to consider bonds with shorter durations.
Makes sense. So to recap, when we're evaluating a bond, we need to look at the issuer's creditworthiness, the yield, the maturity date, and the duration.
That's a great summary. You've hit all the key points.
And of course, we always need to consider our own investment goals and risk tolerance.
Absolutely. There's no one-size-fits-all approach to bond investing.
It's about finding the bonds that best align with our individual needs and objectives.
Precisely. And speaking of individual needs, I think it's time we addressed another important factor: liquidity.
Liquidity. That sounds familiar, but refresh my memory.
Liquidity is essentially how easily you can buy or sell an asset without affecting its price.
Right, so a highly liquid asset is like cash. You can easily convert it to other assets without losing value.
Exactly. And with bonds, liquidity can vary quite a bit.
Okay, so some bonds are easier to buy and sell than others.
Right. Generally, government bonds and bonds issued by large, well-known companies tend to be more liquid than bonds issued by smaller or less established companies.
So if you need to access your money quickly, it's important to choose bonds that are relatively liquid.
Exactly. You don't want to be stuck with a bond that you can't sell when you need to.
Makes sense. So we've talked about creditworthiness, yield, maturity, duration, and now liquidity. It seems like there's a lot to consider when evaluating a bond.
There is, but it's not rocket science.
No, but it does require a bit of research and analysis.
It does. But the good news is that there are plenty of resources available to help investors make informed decisions. Well, financial websites, broker research reports, and even good old-fashioned books can provide valuable insights into the bond market.
And of course, if you're feeling overwhelmed, you can always consult with a financial advisor.
Absolutely. A good advisor can help you create a bond portfolio that meets your specific needs and goals.
So folks, don't be afraid to ask for help if you need it. Now, before we move on to our next bond adventure, I want to make sure we've covered all the bases.
What else is on your mind?
Well, we've talked about how to evaluate individual bonds, but what about constructing a diversified bond portfolio?
Ah, yes. Diversification is key. Just like you wouldn't put all your eggs in one basket, you don't want to put all your money into a single bond, or even a single type of bond.
Right, because if something goes wrong with that one bond, you could lose a lot of money.
Exactly. By spreading your investments across different bonds with different issuers, maturities, credit qualities, and so on, you can reduce your overall risk.
So if one bond performs poorly, it's hopefully offset by others that are doing well.
Precisely. And there are different ways to diversify your bond portfolio.
Such as?
Well, you can diversify by issuer, meaning you invest in bonds from different governments and companies.
So you're not putting all your faith in a single entity.
Exactly. You can also diversify by maturity, as we discussed earlier with laddering.
Right, that helps smooth out returns and reduces interest rate risk.
You got it. And you can diversify by credit quality by investing in bonds with a range of credit ratings.
So you have a mix of higher risk, higher yield bonds and lower risk, lower yield bonds.
Precisely. And there are even specialized bond funds and ETFs that can help you achieve instant diversification.
So you don't have to go out and buy dozens of individual bonds.
Exactly. You can buy one fund or ETF that holds a basket of bonds.
That's pretty convenient. Now, I'm curious, are there any particular types of bonds that are considered core holdings for a diversified portfolio?
Well, U.S. Treasury bonds are often seen as a core holding, especially for investors seeking safety and stability.
Makes sense, given their low default risk.
Right. And investment-grade corporate bonds can also be a good addition to a diversified portfolio, offering higher yields than treasuries, but with still relatively low risk.
And if you're looking for inflation protection, those index-linked bonds we talked about can be a valuable tool.
Absolutely. The key is to build a portfolio that reflects your individual risk tolerance, investment goals, and time horizon.
Right, there's no one-size-fits-all solution.
Exactly. Now, before we wrap up this part of our bond journey, I want to leave you with one final thought.
Okay, I'm all ears.
Bond investing doesn't have to be boring.
Wait, what? Bonds are exciting.
They can be. Sure, they might not have the same sizzle as stocks, but bonds play a crucial role in a well-balanced investment portfolio.
They provide stability, income, and even growth potential.
Exactly. And by understanding the nuances of the bond market, you can make informed decisions that help you achieve your financial goals.
Those folks, don't underestimate the power of bonds. They might just be the secret weapon you need to reach your financial destination.
Now, are you ready for the final leg of our bond adventure?
Absolutely. Let's dive into the world of bond strategies and explore how we can put all this knowledge to work. Welcome back, bond adventurers. We've journeyed through bond basics, learned how to evaluate them, and even dipped our toes into diversification.
We've covered a lot of ground.
But now it's time to talk strategy. How do we actually put all this knowledge to work and build a bond portfolio that aligns with our goals?
All right, so when it comes to bond strategies, there are a few key approaches that investors often use.
Like what? Give us the rundown.
Well, one popular strategy is called passive investing.
Passive investing, that sounds pretty laid back.
It is. It's all about building a diversified portfolio of bonds and essentially holding them for the long term.
So you're not actively trading or trying to time the market.
Exactly. You're basically riding the waves of the bond market, accepting the ups and downs along the way.
So it's kind of like a set it and forget it approach.
You could say that. It's a popular strategy for investors who are looking for a relatively low-maintenance way to invest in bonds.
Makes sense. So what are the benefits of passive investing?
Well, it's generally less time-consuming and less expensive than active investing.
Right, because you're not constantly buying and selling bonds.
Exactly. And it can also be more tax efficient because you're not realizing capital gains as often.
Okay, so lower costs, potential tax advantages, and less time commitment. Sounds pretty good. But are there any downsides?
Well, with passive investing, you're essentially accepting the market's return.
Meaning you're not trying to outperform the market.
Exactly. You're basically going with the flow.
So if the bond market is having a bad year, your portfolio will likely reflect that.
That's right. And you're also giving up some control over your portfolio because you're not actively making decisions about which bonds to buy or sell.
So it's a trade-off between simplicity and potential control.
Exactly. Now, if you're looking for a more hands-on approach,
Right.
there's always active investing.
Active investing, that sounds a bit more, well, active.
It is. Active investors are constantly monitoring the market, looking for opportunities to buy undervalued bonds or sell overvalued bonds.
So they're trying to beat the market, essentially.
That's right. They're trying to generate higher returns than they could achieve with a passive strategy.
Sounds ambitious. But what are the risks involved?
Well, active investing requires a lot more time, effort, and expertise.
You really need to know what you're doing.
Exactly. And even experienced active investors don't always get it right.
So there's no guarantee that you'll outperform the market.
Nope. And in fact, many active investors actually underperform the market after fees and expenses are taken into account.
So it's a high-risk, high-reward strategy.
You could say that. It's not for the faint of heart.
Okay, so passive and active investing are two broad approaches. Are there any other specific bond strategies we should know about?
Absolutely. One strategy that's particularly relevant in today's environment is called interest rate anticipation.
Interest rate anticipation, that sounds intriguing.
It is. It basically involves trying to predict future interest rate movements and adjusting your bond portfolio accordingly.
So if you think interest rates are going to rise, you might.
Shorten the maturities of your bonds.
Right, because when rates rise, the value of existing bonds falls, and that impact is greater for bonds with longer maturities.
Exactly. And if you think interest rates are going to fall, you might
lengthen the maturities of your bonds.
You got it. You're a natural at this.
I'm learning from the best. But isn't it risky to try to predict interest rates?
It can be. Interest rates are influenced by a complex interplay of factors, and even seasoned economists get it wrong sometimes.
So it's not a foolproof strategy.
Definitely not. But for investors who are confident in their interest rate forecasts, it can be a way to potentially enhance their returns.
Okay, so interest rate anticipation is one specialized strategy. Are there any others we should have on our radar?
Well, there's also sector rotation.
Sector rotation. That sounds like something out of a science fiction movie.
It's not as futuristic as it sounds. It basically involves shifting your investments between different sectors of the bond market based on economic conditions and industry trends.
So you might overweight certain sectors that you believe will perform well and underweight others that you think will lag behind.
Exactly. For example, if you believe that the technology sector is poised for growth, you might increase your allocation to technology bonds.
Makes sense. But how do you identify those promising sectors?
Well, it involves a lot of research and analysis. You need to understand the macroeconomic landscape, industry dynamics, and the competitive forces at play.
So it's not for the casual investor.
It can be quite complex, but for investors who are willing to put in the time and effort, sector rotation can be a way to potentially generate outsized returns.
Okay, so interest rate anticipation and sector rotation are two specialized strategies. Are there any others we should be aware of?
Well, there are many other strategies out there, but I think we've covered the main ones.
Sounds good. So to wrap up this part of our bond journey, I think it's important to emphasize that there's no one right way to invest in bonds.
Absolutely. The best strategy for you will depend on your individual circumstances, goals, and risk tolerance.
Right. It's all about finding the approach that aligns best with your needs.
Exactly. And remember, bond investing doesn't have to be intimidating.
No, it can actually be quite exciting.
It can. And by understanding the basics and developing a sound strategy, you can make bonds a valuable part of your overall investment portfolio.
Well said. And on that note, I think it's time to conclude our epic bond adventure.
I've thoroughly enjoyed exploring this fascinating world with you.
Me too. And to our listeners, thank you for joining us on this journey. We hope you've gained valuable insights and a newfound appreciation for the power of bonds.
Remember, bonds are more than just pieces of paper. They represent loans that fuel economic growth, support governments, and help companies thrive.
So the next time you hear about bonds in the news or in financial report, we hope you'll listen with a more informed ear and a deeper understanding of their significance.
Until next time, happy investing.
And keep exploring the world of finance.